As we sit here on the morning of March 18th, awaiting news of the Federal Reserve Board's decision on interest rates later on today, I thought it might be instructive to take a look at the activity that the Federal Reserve and some of the other central banks globally have taken over the last little while in order to lessen the effect of the subprime turmoil and the global credit crisis. Over the past 10 months, central banks globally have been very active in providing liquidity into the banking system, essentially giving banks access to cheaper funding. But over this past weekend of March 15th, 16th, the Federal Reserve took that participation to a little bit of a different level, and I think it's interesting to look at it for a couple of different reasons. The Fed has always been a lender of last resort to the commercial banking system in the U.S., basically meaning that whenever a bank cannot, for any reason, fund the liabilities that they have on their balance sheet from day to day, i.e. loans that they've made to other entities, that they can borrow from the Federal Reserve. Over this past weekend, the Fed took some fairly dramatic steps to make that access cheaper and more readily available both to the commercial banks and to the broker-dealers in the U.S. And that has some pretty significant ramifications for the financial system going forward. The other thing that they did, which was perhaps more dramatic, was they played a significant role providing $30 billion in financing to allow J.P. Morgan to complete a purchase of Bear Stearns. Late last week, Bear Stearns had some significant problems with regard to their solvency, and some might even say that they were technically bankrupt. They've seen their stock price go from over $65 on Thursday to $2, which was the buyout price that was arranged on the weekend. So essentially the equity of all of Bear Stearns' shareholders has been largely wiped out, and there'll be some pretty serious ramifications for Bear Stearns' employees going forward. But what the Fed essentially has accomplished in allowing or in brokering this situation is to keep the credit system and the banking system in the U.S. from seizing up even more. Bear Stearns is a fairly significant player in the global financial system and is the counterparty to quite a number of other institutions and contracts on the books of other institutions. So had they gone into bankruptcy, there would have been a significant period over which there would have been uncertainty around the settlement of those contracts. And in effect, the financial system would have become much tighter. By doing what they've done in this instance, the Fed has demonstrated a willingness, or a lack of willingness really, to allow the financial system to tighten up even more. And by so doing have given a significant degree of confidence to the market that should problems be faced with other counterparties or with other institutions in the next little while, that the Fed or other central banks will be there to bail them out. The other aspect of Fed activity that I think we'll see later today that I alluded to earlier is a significant cut in interest rates. And that activity, as past interest rate cuts have been, is intended to ward off or mitigate the effects of a slowdown in the global economy, dictated or driven primarily by a reduction in U.S. consumer spending. In summary, while recent Fed activity has been significant and further interest rate cuts will have an effect on the global economy going forward, I think it's important that people don't take central bank participation as being a panacea in terms of the current global financial crisis. And no one should allot more capital or take more risk based on the belief that central banks will make everything okay. I think that the activities that the Fed has taken over the last little while that I've referred to here are significant and will certainly help to ease the global credit crunch situation, but should not prompt investors to do things that are outside the realm of their own personal circumstance.